Hey everyone, and welcome. We're jumping right into a pretty wild financial story that absolutely shook the markets back in January of 2026. I mean, you had this incredible surge in gold prices happening on one side, and at the very same time, a stomach-churning stock market crash. It's like two sides of the same coin, but they were moving in completely opposite directions. So what exactly went down? Let's break it all down.
Okay, let's just start with this number. On January 21st, the price of 24-karat gold just skyrocketed. It smashed right through that historic 1.5 lakh rupee barrier for just 10 grams. And listen, this wasn't some small jump. This was an all-time, lifetime high. A massive, massive milestone for the Indian gold market.
But get this, at the exact same time, this is what was happening on Dalal Street. The BSE Sensex completely took a nosedive. We're talking a plunge of as much as 1,056 points in a single day of trading. Billions of dollars in investor wealth just poof, gone. So you've got gold shooting for the moon while stocks are hitting the floor.
Which, brings us to the big question here. What on earth is going on? How can two of the most critical financial indicators in the entire country have such a violent and totally opposite reaction? Is this just some bizarre coincidence, or is there something much, much bigger at play? Well, as you probably guessed, this was not a coincidence at all. This market madness was a direct reaction to a single major geopolitical shockwave that sent ripples across the entire globe. And yeah, they hit India's markets hard.
The catalyst, and this commodity report really nails it, was escalating US-EU trade and geopolitical tensions. When the big global powers start rattling their sabers, money gets nervous. And when money gets nervous, it starts moving, and it moves fast.
And the flashpoint was something I don't think anyone saw coming. The Greenland dispute. U.S. President Donald Trump went all in on his goal to acquire Greenland. He started threatening a whole new wave of tariffs on the European Union if they stood in his way. He even refused to rule out using force. And that just immediately sparked fears of a brand new, incredibly destabilizing global trade war.
So you might be asking, how did this one dispute cause such a huge reaction? We'll start with the first half of the story, this great flight to safety, and why investors suddenly couldn't seem to get their hands on enough gold.
It all boils down to this one key concept, the safe haven asset. Think of it like this. When a financial hurricane is brewing on the horizon, investors do not want to be caught out in the open. They're looking for a storm shelter, right? A bunker to protect their wealth. And for centuries, gold has been seen as the ultimate financial bunker.
And you can literally see how quickly that fear escalated just by looking at the price. On January 19th, gold futures hit a new high. The very next day, physical gold jumped again, almost touching that 1.5 lakh mark. And then by the 21st, boom, it exploded right past it. It's a perfect timeline of rising panic.
Okay, so now for the other side of the coin. If investors were running to gold for safety, what exactly were they running from? Well, that takes us right to the great stock sell-off.
This slide just illustrates the difference perfectly. Gold is seen as a simple store value. It actually thrives on fear and uncertainty. Stocks, on the other hand, well, they represent a piece of a growing business. They need confidence, they need stability to do well. So, when that storm hits, gold feels like a solid bunker, while the stock market, that suddenly feels like a very exposed and very dangerous open field.
And the damage was just immense. Over just 3 days, the Sensex dropped by nearly 2,500 points. The total investor wealth that was just wiped out was over 9 lakh crore rupees. And you can see a key driver right here. Foreign investors pulled over 29,000 crore rupees out of the Indian market in January alone. They were leading the exodus.
Now, for the market veterans, this was a really worrying sign. The Nifty 50 index broke below its 200-day moving average. This is a huge technical and psychological line in the sand. It's often seen as the dividing line between a long-term bull market and a bear market. So to breach it, that signals the potential for even more weakness ahead. So with the market in total turmoil, gold at record highs, and these key technical levels just shattered, everyone was asking the same thing. What happens next? And, as you might expect, the experts were completely divided.
After a crash like this, is it a massive red flag telling you to run for the hills? Or is it actually a rare opportunity to buy into the market at a serious discount?
So on one side, you have analysts like Gurmeet Singh Chawla. His argument is that this is just a healthy reset. It's a panic attack, not some fundamental breakdown of the market. For him, these are the moments that long-term investors actually wait for, a chance to accumulate great companies at cheaper prices. But then, on the complete other side, you have the technical argument from experts like Santosh Meena. He points to that broken 200-day moving average and warns that it could be technically catastrophic. He's basically saying, look, this isn't just a dip. This could be a real structural shift in the market's direction, signaling a lot more pain to come.
And that leaves us all with the ultimate question, doesn't it? Not just for this one event, but for all investing. When a single geopolitical surprise can completely upend global markets overnight, it forces all of us to ask, in a world this uncertain, where really is the safest place for your money? Thanks for joining me.